to share with your clients and prospects, and just even to say, hey, have you seen this? This is the US national debt. And interestingly, when this guy had a screenshot of when he first built his presentation, he had a PowerPoint and he had this, and he built his presentation back in June and has been giving it. And this US national debt, I don't know, it was like 26 or 27 trillion, I think that is. And now look at it, it's 28. And it's just gross of how fast this is growing. And this is the reason why something has to break. You know, recently in news, we hear about they had to emergency meet and raise the debt ceiling because there are laws as far as how high the debt ceiling can, how much debt the US can have. And if they can't pay, if they can't take in more debt, then they have to shut down the government. And this is what this is about. And this is why there is all this talk about tax and increasing taxes, because this debt keeps going up. I think this number down here on the bottom of this line here where it says US federal debt to GDP ratio. GDP is gross domestic product. It is a measure of the economy and what we're producing and what we're creating, and goods and services. And you look at the ratio of the debt to the GDP, and you go back all the way to 1960 through 1980, you know, I mean, it was a 50% ratio, less than 50%. Now we have more debt than GDP by 125, 25%, 26% greater. That's scary. That's what keeps going up. And so, I mean, it's just good to share this with people. This is the why. This is what the government is dealing with. We can't stay on this course. I think there are, just as a quick aside, I think there are some other cool things on this website, this clock to bring up in this area here of savings per family, credit card debt per holder, you know, and to simply say, you know, where are you in here? Are you above the average? Are you below the average? This is what I help people do. I help people to eliminate debt, to maximize their efficiency with the dollars that they have coming in. This is where I have techniques and strategies and tools that we use to help you in your situation long term. It's never a get rich, and you should be immediately thinking, okay, what are those things? Well, that's like the power of zero, and that whole process. If you don't have the Power of Zero book, get the Power of Zero book. I have some. I'll bring some to our next firm-wide meeting, which is in two weeks in Lisle. In a different building. We'll continue to hammer on that. We're not in the 800 building, we're in the 1000 building. So 2 buildings to the west. But Power of Zero, of how people can get to the zero tax bracket. This is bank on yourself. And look at the bank interest paid over here. And how that just ticks along, and what people pay to banks in interest for car loans and mortgage loans, and credit card debt is over here. And bank on yourself, or create your own bank, or be your own banker. That's what I help people to do, to eliminate or mitigate those kind of things in the infinite banking concept. So the other thing is there's gonna be, even though it's not out there, and we'll get into the specifics of what tax changes are coming. This is from this screen, you just ask people, what do you think taxes are going to do in the future? And in one way or another, they're going to go up. So pay your taxes now, to move them from taxable vehicles, or they're in tax deferred, and pay it now and get it into a vehicle that is not taxed, or you can access it on a tax favorable basis, is a wonderful strategy. So let me end this here and go to share my screen on what this deal looks like. Now, I do want to point out this 125% deal. Not as horrible as some countries. There are countries in Europe like Spain and Greece and Switzerland that are actually even greater than that. However, those are not the countries that we're trying to model ourselves after necessarily. And it's so inefficient to be paying taxes or paying interest on these dollars on that debt. Okay, so let me bring up here. I got 1, 2, 3, 4, 5, 6, 7. Perfect. All right. So this is that screen we just saw, or the tax clock. This is it over a period of time. Blue line is specifically what that debt has been, the US debt. And it was kind of chugging along at a through 1970 through 2000. It was increasing, but not at a crazy rate. You can see there, 3 trillion, 5 trillion. It's only been in the last 20 years that it's gone through the roof. And this is the unsustainable place that we are. And so to give people a context of this, and what we're trying to do is get people to understand, what do you think your personal taxes are going to do? And are there things that you can do then to mitigate that? And there are different kinds of taxes, as you well know. There's all kinds of taxes, and we'll talk about income taxes. But the interesting thing that this guy kind of talked about were the death taxes, so estate taxes, and these were 3 areas that, and I've seen one of them talked about pretty heavily in the increased capital gains tax rate. That just came out of the House Ways Committee of proposed increase on that. But these other 2 have been bantered about in some other committees, and these were some that he talked about. So the estate tax exclusion limit and a step up in basis at death. And I'm gonna speak to, a level of, you may not even understand that. And I think that's helpful to you. Your average consumer, your average prospect and client doesn't even really understand these. We haven't talked about estate taxes in a long time because the estate tax limit was so high, or is currently so high. So this is the current and history of the estate tax limitations. And you can see way back in the 90s, it was 600,000. And I remember this very well because I had a case just like this. And what that meant is, when somebody passes away, and they're going to pass on their estate to their next of kin, they put everything in a box, in a figurative box, and add it up. Their business, their assets, their house, their IRAs, they add it all up. And then they say, okay, you get to exclude this first amount. That amount won't be taxed. And then everything over that, you have to pay at a rate. And sometimes those rates graduate the more that you have, etc. And that rate often goes up to as high as 50%. So I literally had a case back in, this was my first big case when I was in coming into this business. I think I was only 2 years into the business. I made the horrible mistake of not doing joint field work. And so I looked like an idiot, but this 72-year-old man who was a widower was pretty patient with me. I counted up at one time and I had over 36 appointments with this guy. And he was worth $3 million. And his wife had already passed. So he missed an opportunity, because you can pass 100% of your estate to your spouse if you're married, without any estate taxes, and so he missed an opportunity because she also had 600,000 of an exclusion. So he could have moved that first 600,000 when she passed to the kids, put it in a trust or whatever, and move it to him, and then he would have had 600. But he didn't do that. He missed that opportunity, and so he knew that he had 2 children. He wanted that dollars to go to them, and he knew that the first 600,000 was going to pass estate tax free. Trying to get my pen to work here again. So you subtract the 600,000 from the 3 million, you had 2.4 million left, and at that time it was going to be 50% of tax. So the kids would have had to pay 1.2 million, and they would have ended up with 1.2 million. And so that stinks. And people are like, I don't want to, I want to pass my whole estate. I want to get as much as possible to my kids. And what do we do about that? And in his case, his assets were spread all around. They could have cashed in some accounts to pay this, because this is due within, I can't remember the amount of time, like 9 months of the date of death. You got to pay that deal off. And in many cases, this $2.4 million of estate is all wrapped up in 1 or 2 things. It's wrapped up in a farm, or it's wrapped up in property. And people are like, well, I wanted my kids to get the property or the business. I don't want them to have to sell. And there are these just great stories out there back at this time. These are the stories we told of how people had to divest the entire estate. They had to sell all the property in order to pay the estate tax that was due, the $1.2 million. One of the most famous is before, I can't remember what they call the Miami Dolphins stadium now. It used to be the Joe Robbie Stadium. It used to be owned by the Robbie family. And the Robbie family lost the Miami Dolphins and the stadium. They had to sell because it was exactly this kind of situation. He died, the dad, when estate tax exclusions were limited. He didn't have the proper planning in place. And so they had to sell the team so that they could pay the estate taxes. Stinks. What did people do? Well, they set up a trust, called an irrevocable trust. It has to be irrevocable because it has to be separate from the family. It has to be, I can't own it. And so when it's irrevocable, meaning I can't change it. An irrevocable life insurance trust, often called an ILIT. They get rid of this R here. An irrevocable life insurance trust. And they gift money into this life insurance trust based on the recipients of the trust. So in my case, there were 2 kids, and you could gift without it being taxed at a level I can't remember exactly. Might have been 12,000. It's now like 15,000. You can gift to anyone without there being a tax to it. And so they gifted in the name of these kids 12,000 each, or a total of $24,000 which then became the premium payment. And then the life insurance trust decided to buy an insurance policy that was worth $1.3 million, so that when he died, this life insurance policy would kick in and pay off this estate tax due. And so we love these kind of cases. We helped people that were in these kind of situations. Sometimes, there needed to be a lot more premium. And so they lined up all kinds of kids and grandkids and what have you, so that you could gift in the appropriate amount, buy the life insurance policy appropriately. If this was a business, then the business could pass intact to the children, etc. That's what the situation was. We did a lot of these kind of cases, or talked about a lot of these cases. Literally, this case put me on the map and gained a lot of confidence. And I was the rookie of the year for my agency, and really not knowing what I was doing. Thank you. 15,000, that is, Gary's telling us, is the current gift tax amount that one can pass to another without it being taxable. And that's current gift tax exclusion. So, I lost my content. Shoot. Sorry about that. I want to go back to this. Let's just put these up here. I'm sorry. So this was a big deal in these, you can see in the early 2000s. Then along came and they started increasing the estate tax exclusion. So much so, we had this one year where there was no exclusion and everything was taxed, and that was just a crazy year. But the last several years, this is what the estate tax exclusion is, 11 million. And this is per spouse or per person. So if you have a married couple, they each have 11.5 million that they can exclude from estate taxes. So you have to be super, super rich to be in this type of situation. This is one of the things that is proposed. Okay, will we bring this level down? And, I've heard back down to the 4 or 5 million place, purely speculative. They may not touch this at all. In fact, what do you think we take in all this tax revenue, and you saw it on that screen. How much of all of our tax revenue, so there are some people that die that are rich that have to pay this, of all the tax revenue, how much of it do you think estate taxes paid attributes to it? So if our tax revenue is a pie of 100%, what percentage do you think comes from estate tax payment? Put a guess into the chat just for fun, if you have a guess. Thank you. Robert guesses 12%. Anybody else have some guesses? What you think? %. Thanks for guessing. Okay. You want to seriously know what it's less than 1%. Less than 1% of all of our tax revenue comes from this deal. And it's kind of goofy because they're going to spend a lot of time and energy and bantering about this. And really, we have very few people who are up in this kind of bracket. Now, if they drop it down, that's what they're trying to do. They're trying to get some big chunks of money. So this is one area. And simply for you to talk about people, to share maybe this slide or share the debt clock, and to say, where is your estate situation? And will it continue to grow? And if they drop this, would this be something that you would get into a situation with? And by and large, we're still talking about the 2%, very few people, but there are people out there. In fact, Elena was talking to about Bob Kramer. He was dealing with one, and I'm trying to finish his case for him for the behalf of his family, where he was dealing with somebody who has this type of will have an estate tax problem if they drop it below this 11. So it is out there. That's one area. Probably a, whoops, get rid of that. Come on. Sorry. Second area that would be detrimental, would be painful to a lot of people, is this eliminate the step up in basis at death. And so it would be, and so here's how taxes work now. Let's go back here, Dennis. Step up in basis is just a great thing for passing on property, and I suppose highly appreciated other assets. Works best if we understand it in the area of property. Let's say my mom and dad have an investment property, or it was also a vacation home down in Florida, and they got it long time ago. And they bought in at a low amount. They saw the property value go way up. Then it came back down in the housing crisis of 2009, 2010. And once again, we're seeing real estate go up crazily in different parts of the country. Arizona, Scottsdale is another huge, big area. But so my mom and dad bought this modest little condo for $50,000. If they were to sell it now, it's worth $120,000. It's a 1-bedroom off the shore a little bit. I'm just making this up. You could, there's examples all over them, bought it for 50 and it's worth 400,000. Let's, it could be that situation. Let's use that. If mom and dad say, you know what, we're not going there anymore, let's sell that. They have a gain of $350,000. They bought it for 50. They sell it for 400. They have a gain of $350,000. They have to pay taxes on it. That is a capital gain. This is a capital piece of property. It's capital. They have to pay taxes on that capital gain. Capital gains have a different rate of tax than income tax. And currently, any guesses or any knowledge? I'll tell you, current rate is 20%. And so they would have to pay. Now, one of the really great things is, mom and dad, don't sell it, because you're going to have to pay 20% of that gain, or $70,000 in taxes. If you just hold it to death, family members say, it's okay, let's put it on Airbnb. I'll take care of the maintenance. That's way better than $70,000 in taxes. Because what happens at death, they die in their wills and trusts, that they say, I want this to go to the kids, and it gets what is called a step up in basis. Basis is what you pay for it. This is basis, the 50,000. At death, it gets a step up in basis to the value it is on the day of their death. 400,000. So now we could turn around and sell it, and there would be no gain, because it got the preferred tax treatment at death. So that's pretty cool. Step up in basis. A lot of times people need the money, want the money. They don't want to leave, the problem to the kids of fighting over it or whatever. You know, this again is why there is planning. This is where you step into place and say, what are you going to do with that property? What's your plan for it? And currently, there is this step up in basis at death. The fact that they are looking at eliminating that creates a whole bunch of ton of revenue. And what would happen in this situation is the basis would stick around forever. Whatever it was purchased for, that would then pass, and whoever sells it, so it could pass to the kids, they're still holding it, but ultimately whoever sells it has to pay these capital gain taxes. Does that make sense? Follow the logic? Feel free to ask any questions or chime in. Rich people avoid taxes by all means possible. That is that is very correct. In fact, our esteemed, I think what is Janet Yellen, the head of the Treasury? She is all over that rich people cheat on taxes. They are trading properties all the time. They're not reporting those, that they're paid on, if you're paid on a W-2, that also gets submitted to the federal government. So they know how much you make. And so the vast majority of people that are paid on a W-2, they know if they're cheating on their taxes or not. People who are selling properties or getting 1099s back and forth, those aren't necessarily reported into the federal government, or they are reported, but then they create fake expenses, etc. So there's a lot of transactions on it, and Janet Yellen is saying, okay, while you guys are working on tax legislation, why don't you just give me more money in the IRS department to have more auditors and more researchers and go after all this fraud that's out there? And one of her things that she is proposing is that banks report every transaction over $600 back to the federal government. And people are crying foul. That's like Big Brother all over me. What do you mean? Every transaction over 600? That's just crazy, and it's going to be expensive, which then banks would send that cost back to us through fees and other things. And she's saying, I'm just trying to go after rich people. But people are saying, well, if you're just going after rich people, why do you make it as little as $600? And this is the whole deal that's going on, that debate that's going on. Cool. Doesn't seem like we have any questions. Very good. All right. So back to our eliminate the step up in basis would be create a lot of taxes, because we wouldn't pass taxes at death in that kind of situation. The last thing is an increase in the capital gains tax rate. And as I stated, it is currently, at 20%. The most recent thing that just came out of the House Ways and Means Committee was that they want to increase this to 25% on any sale of any property. And so that's not just a house. It could be a house, it could be a business, it literally could be stock. I bought this stock. I bought this exchange traded fund, and I bought it at $11, and now I'm selling it 2 years later. For it to be a long-term capital gains tax, it has to be over 1 year. Otherwise, it's short-term, which then I think falls to the regular income tax rate. And so this is a big deal. In fact, if a lot of people are advising, if you've got stuff to sell, if you're considering selling, sell it now versus waiting, because there's an extra 5% for you there, right there in the middle. Again, not passed. It's all speculative. The proposal out of the House Ways and Means made this one retroactive, that anything sold after September 13th. So they would say, even though this law goes into effect in 2022, we're going to go back to 2021, September 13th, and say anything that was sold gets subject to this increased rate, which seems kind of punitive. It doesn't give people a chance, but we'll see how it ultimately comes out. I think there's a very good chance of that happening. The other thing is just our current income tax rate. So those were, long-term capital gains rates. Those were death taxes. What creates all of our revenue is regular income tax rates. And when the Trump administration came in to play, they cut those rates. They passed that legislation with a sunset, meaning that the current rates are set to expire at the end of 2025. So even if nothing gets changed, those rates will go back up to their pre-2017 level. So we have this window of opportunity. This is what David McKnight always talks about. There's this looming tax bomb coming, and for sure you have another 4 years to take advantage of it, unless they go and repeal it. And they could repeal it because now the scales have tipped as far as the votes. However, it's very interesting with the Democrats. There's a lot of infighting going on there, so who knows what can get done passing tax legislation anyway. So here's our current tax rates. This is what you and I are all dealing with, and all of your clients. And there is opportunity in this in and of itself. Move that out of here. So helping people understand this, I think, is huge, because we have a progressive tax system, which means you pay a higher rate on the increasing amount of dollars that you earn. So on the first, let's say I'm a single individual. On the first $9,950, I pay 10%. Then, as soon as I get into the next dollar, my next dollar over 9,950, $1 over that, on that dollar, I'm paying 12%. And then I pay 12% on all of my rest of my dollars up to 40,000. When I go over 40,000, my next dollar I earn, now I'm going to give up, I only get to keep 78 cents of it, and I'm giving 22% of that to the federal government. And as you know, there are other taxes of like FICA that are coming out of that, state income taxes, etc. Where the state of Illinois is a flat tax across all income of just about, 5%. The federal tax is a progressive system. What it means is I'm paying more and more on the higher amount I go. I don't pay 24%. If I'm making 150, I'm not paying 24% on all 150. I'm only paying 24% on the amount between 86,000 and 164. Get it? So that's why we often figure out what a person's total tax is. Their total tax is maybe around 20% when you average it all out, if they're in that range. And we talk about marginal tax bracket because you're in this margin. If I make 150,000 and I'm a single taxpayer, I'm in the 24% margin. I won't jump to the next bracket on that next dollar until I get over that 164,925. So this is a great time to just meet with people and say, where are you going to come out this year? We're sitting here on October 13th. You know what you have for 10 months of income. And this is especially true for commissioned people, small business people, people who have multiple streams of income, people who draw on IRAs or are drawing out of tax qualified. Because if I'm made 150, the point is maybe you should draw out, if it looks like you're going to end at 150 this year, take another 14,000 out of whatever and pay the taxes on it, because that 24 might be lower than it will be in the future. You're going to have to pay. This is especially true of people who have IRAs and are over 59 and a half. This is David McKnight's whole deal, is pull it out of the taxable part, pay your taxes on it today, and stick it back in to something that you're going to be able to access and not have to pay taxes on it. And that's what a Roth conversion is. People take it out of an IRA, pay the taxes on it now, stay below their marginal tax bracket, don't force themselves into the next one, or may make the decision, I'm gonna go ahead and do it because I think taxes are gonna go up, I'm gonna play that game, pay the taxes on it and stick it into a Roth. That's one way. That's the backdoor Roth is there for people who were never eligible because of income level to contribute to a Roth, but they can convert their IRA to a Roth. That's what's called a backdoor Roth. You got in through the back door. There's legislation out there that is looking at eliminating that or putting caps on that. Again, it's at very high income levels. It doesn't impact a ton of people, but sharing knowledge, sharing ideas moves people to make some decisions and make some changes. And they say, man, you're really a smart person. I want to work with you. What about this? I got a lady right now who is looking at long-term care, and she's not considering, well, she potentially is considering a Roth conversion, taking it. She's got just a ton of money in old 401ks, a lot of money in qualified money. She wants to get it to her daughter in the most favorable. She's worried about long-term care as well. Well, instead of doing a Roth conversion, let's put it into One America's asset care that takes qualified money. You're creating your own. So you're going to pay over 10 years. You're drawing it out. You're paying the current tax rates on it. You're spreading it out over 10 years. You got at least these good years where the tax rate is lower. We don't know what's going to happen. Start now. Get your long-term care secure. Also, if you never use it for long-term care, there's a death benefit that pays out income tax-free. So it's a pseudo Roth conversion. It's using up money that is taxed now. Pull it out now. You're going to either pay me now or pay me later. If she did nothing and she doesn't use that, she's got $500,000 that's going to her daughter in a taxable form. Then her daughter has to pay it at her rate, which could be higher. So taxes are just the great, especially this time of year, tax planning. Where are you lining up? Use up your margin, get up to that level. Do you think taxes are going to be higher or lower in the future? And inevitably, they're going to be higher. Does that make sense? Obviously, this guy is on, this economist in the advanced marketing department of AIG is on our side as well with this deal. If income tax rates go up, there are places to put dollars. And this again is the whole infinite banking concept, but there's other reasons to do it other than infinite banking and paying off debt. It's to create wealth inside a vehicle. And have there been ripplings about, wow, look at all the money that's sitting in life insurance? There always is, but this is why we have NAFA as our lobbyist group, and it protects us from them going after taxing the tax deferred buildup inside of life insurance or the tax-free distribution. And again, these are just great vehicles to have to stick dollars, let it grow tax deferred. I can access it through loans or withdrawals on a favorable basis, no taxes, and I can pay it out to my beneficiaries tax-free at death. All right. I think, let me see if that's everything that I wanted to call out. I would tell you that you could find this presentation, you could find a video of this whole presentation. I don't know how, if you wanted to, I can get you the exact link, but AIG has just a great website that they support that is called retirestronger.com. retirestronger.com. Incredibly, a lot of resources there, a lot of tools for prospecting, marketing, sales presentations, just a very good piece there. Colleen, I'm going to ask you about Day with MDRT. As far as when that is, next week on this hour of time is annuities and all the various types, and specifically which ones might be the best in specific categories. I asked Bo, what's the, from a fixed index standpoint, what's the best in his opinion right now in the growth area? What's the best in an income area? What's the best in a short term, the multi-year guaranteed as a CD alternative, 2, 3, 4, 5? What's the best is linked to long-term care. You can bet One America's will be in that category. So that's next week, and then the week after is our firm-wide meeting in person. We will definitely do that. We will also broadcast for those of you who want to do that. So that's October 27th in the 1001 building, right, Colleen?
Yeah.
And when is Taste of MDRT? This is, I talked about NAFA. NAFA is our lobbyist group that keeps life insurance intact. They also put on presentations. This is the deal that some of us went to down in Peoria. They have one at the, I think it's again at the Itasca Country Club, right?
Yep.
And what's the date of that?
Thursday, November 4th.
Okay, so your call. You want to be there. If you're brand new to the industry, or you can join NAFA for $10 a month when you first get in. It goes up from there, obviously, but just to get a sense of it. People swear by it, and our leader, Mr. Chris Gandy, is now a national trustee of NAFA, which is huge. We also have great participation in leadership from Eric Essex, from Dave Cacone, Ray Shimizu, just outstanding. And as an independent boutique firm, it makes a difference for us. I would say one last thing I want to show you. Share one photo. Just these came out today. I did say One America is our main squeeze. It's where our broker dealer is. It's where we get our career services from, and it's where we do the bulk of our business. But we are not We give them the first right of refusal. We like doing business with them, but we're not beholden to them. We do what's right by our client. And they don't have every product, and they don't have necessarily the best product in a place or what our client is looking for. And you can see through year to date, Wella Financial here, as a young burgeoning place, not yet 5 years old, we have continued to grow. We have already surpassed last year. That is due to all of you. They track as far as first year commission. And so anything we sell through One America, we love to sell their life insurance products. This Care Solutions is the asset care and annuity care. That should be a higher number, quite frankly. This is our securities over here, this column over here. And mostly I put this up there to say thank you. It is because of you, the impact that we are making, and that we continue to grow. Obviously, Mr. Gandy makes a huge difference in that number, but every last person who does business contributes to this number, and you are making a huge difference. So we appreciate that. And with that, I will sign off unless there's any questions. I'm going to go to chat and see if there's anything in chat. Colleen, you got anything?
Nope.
All right. All right, everyone. Thank you greatly. Keep up the good work. Help your clients, educate your prospects. Say, man, we got to sit down. We got to start with a fact finder, see where you're at. I might have some tech strategies for you. All right. Bye-bye.